All right, so now post-lunch over here, we have some finance gurus, you can say, who would be speaking about private credit, debit, and direct learning over here, lending, which can investor find yield into. So over here, may I please, as I can see all my juries here, and may I please request all of you to put a round of applause for Mayank Sharma over here, Director and Head, Alternative Investments, Product Wealth Management, Standard Chartered Bank. Everybody, woo! Then we have Rakshat Kapoor, CIO and Fund Manager, Centrum Private Credit. Come on, everybody, make some noise. Ravi Vukkadala over here, CEO, Northern Arc Investments. Everybody, zordar taliyan. Then we have Saurabh Jhalaria over here, CIO, Alternative Credit Strategies InCred. Come on, everybody, make some noise. So, a big round of applause to my gentle speakers over here. Thank you so much. Over to you, gentlemen. Thank you.
Thank you, and thanks a lot, Equalify, for inviting us for this session. Before we start, big congratulations to all the 40 under 40 winners. I think it's a great feat, and wishing you the best in your future careers. So now coming back to the topic. So since morning we had multiple sessions which were primarily focused around equities or private equity. So now here we are going to talk about another asset class, debt, which sounds a little boring. But again, I think we have seen difficult times for both debt and equity in the last 1 year. Not just in India, even globally. I think if you look at history, in only 4 years out of 150 years, both debt and equity have delivered negative returns in US. And last year was one such year. Obviously, there has been a lot of change which has happened globally in terms of macros, with US Fed and all the developed markets increasing rates to control inflation. Maybe we are towards the end of that cycle in India also. Anyways, in India, we did not face that kind of inflation problem because we did not have that kind of monetary and fiscal stimulus. Again, India, we are again yet to see a monetary policy tomorrow. Expectation is we may see another 25 basis point hike and then a long pause after that. So macros look fairly interesting, but what we have seen is that debt yields have improved significantly in the last 1 year or so. Now here, what we are discussing is more on the private credit side. So private credit, on the AIF side, you have different kind of strategies to play this space. You have performing credit, you have distressed credit, you have venture debt. So we have 3 specialists from this category itself, I think. So maybe I would want to start, just wanted to understand how big is the category in India currently, and what scope do you see for growth in this category? We have seen a lot of funds coming in from a lot of different providers in this space in the last 3 to 4 years. Again, you may also want to give some global parallels on how big is this category globally. So Ravi, if you want to start.
Sure. So thanks everyone for having me here. Before we get into answering or giving numbers, how many understand what private credit is as a category? Show of hands. There's barely about 20-25%. Right? So probably everybody understands what debt is, right? You give money, you hopefully get it back with some returns, right? Now there is public debt and then there is private credit debt. Public is the listed companies, the safer companies as you would call it, or the higher rated ones, which typically a lot of corporates invest in mutual funds, typically a duration kind of strategy where they say you take a call on an interest rate. Credit is, I can give a loan to a friend of mine and hopefully I'll get it back. That is private credit. Right? It's governed by a private contract between two. So when you say how big the market is, everybody does lending and borrowing. If you do it in an organized form with contracts, with legal documents, then it is private credit. And earlier, the only exposure that most folks would have had it, at least the retail folks, would have been through mutual funds, which is the credit risk funds. And then something happened a few years ago, which everybody is aware of. And now that is not a place where people go for credit. It was still public listed debt, but it was unlisted companies, and hence it was private credit. That category itself came to about 70,000 crores. Right? So that is the kind of pool of capital that investors had put in to get an accrual interest returns. I want 9%, 10%, 11% kind of returns in mutual funds. Right? Before that, so if you talk about my parents or the generations before, the rates that they were used to were 12, 15, 18% from the government. Those days are gone. Double your money in 5 years is not happening anymore. So mutual funds is the only place where somebody could get this kind of yields or returns, and that is about 70,000 crores. Everybody saw the budget, that there was a market-linked debenture taxation piece that happened. That category itself, there is currently outstanding stock of more than 1 lakh crores in the market-linked debenture space. Right? So this is where investors have put in money, and this is distributed only in HNI, you can say some higher ticket retail and UHNI categories. So 1 lakh here, 70,000 in mutual funds. Now if you look at loans or credit overall, the banking system has about 100 lakh crores of outstanding debt in the country, right? And earlier, a lot of this used to be corporate. Now it has moved to kind of 50-50 share. So still half of that is corporate credit. So it's money that corporates need for working capital, for growth, for all kinds of purposes, right? All of that is private credit, but that is in the banking market. So if you see in terms of NCD debt where investors have subscribed, you can say the number closes to about 1 lakh crore or so. If you see in terms of the total amount of pool of money that is deployed in loans, etc. and all, that would aggregate to about 50 lakh crores kind of size. So there is a lot of potential, obviously. A lot of it is in the bank side. It is not on the public or private market as much. And over the last 5-7 years, I compare the debt market to have gone through a change like how the equity market did in the early 2000s, where every kind of debt is now given by a certain kind of institution. So let me explain that. There are mutual funds, there are NBFCs, there are insurance companies, and there are banks. These are the primary providers of debt or providers of money. Right? Mutual funds have now, through a lot of action by SEBI, concentrated them in the AAA to somewhere towards A-rated public credit, right? Especially after a couple of funds were closed. NBFCs, some of them, such as Northern Arc, do private lending in unrated credit as well, but most of the NBFCs are largely towards retail credit, so that's still a smaller amount. Insurance only works in AAA, etc. and all, and the rest of it is all in the banking sector. So overall, this is the kind of landscape. Investors have not participated meaningfully in debt because first they were used to high interest rates, or at least the generations before me. Then equity market was largely the one that people went to, and into credit risk funds. Subsequently, now with market-linked debentures going, and very clear categorization between what a bank, mutual fund, NBFC and a fund can do, I think the market is ripe for private credit across alternate investment funds or across PMS kind of schemes, or direct credit as well for those who understand that space, for it to grow and get some of that market share from banks, which are going more towards retail credit. So that's kind of a long answer to your very specific question, but I wanted to put some context on it as well.
Thanks.
But just to sort of add, I mean, just to add to what Ravi said, that if you sort of look at the opportunity set as such, I would like to point out 2 points here. One is the the total, say, a bank credit market, which is, I think, almost like 100 or 135 lakh crores. So in that, I think about 40 or maybe 50% is of the corporate book. Now within the corporate book, if you look at, I think there is the AAA and the AA segment, which occupy maybe 85-90% of the thing. So the 10% that is left out of the corporate piece of that 135-140 lakh crores, I think is a sizable opportunity if you look at. That itself comes to almost like 5 odd lakh crores. Then second is, the bonds market, right? So if you look at, I think the total outstanding bonds would be somewhere around maybe 40 lakh crores thereabouts. Now, and within that, 87-90% again is skewed towards AAA, AA. So I think single A category corporates and maybe below that occupy 10% that itself. So together, if you look at the 4 5 lakh crore out of the bank market and maybe another 4 5 lakh crore out of the bond market. So itself is a 10 lakh crore sort of market, which is itself is about maybe whatever 125 billion dollar market in terms of the private credit opportunity that throws up out of India today.
Thank you. So what kind of depth does the market have currently in terms of participation from different segments, say UHNI, family offices, domestic institutions, global institutions? And do you see liquidity in this segment, specifically in the AIF segment which you operate? Do you see enough liquidity in that segment for the transactions which you do?
I can attempt that. So the different investors in this segment outside the traditional banks has largely been mutual funds and now the PMSs and the AIFs. The foreign investors which invest through the FPI route is another asset, sort of another pool of liquidity. We've seen them operate with a very specific mandate in terms of either an impact or a development mandate or some sort of a special situation, large ticket, bankruptcy related stuff. We don't see them in the bread and butter, mid-market corporate segment, which is what a lot of AIFs are now trying to capture as a under-penetrated or sort of requires capital, but not enough pools of capital that cater to it. Within, Ravi and Rakshat spoke about the mutual funds and the banks. Globally, this industry is about a 200 billion plus industry. Cumulatively, all the AIFs put together in India is maybe roughly around 3.5 billion. For a debt penetration, where India is massively underpenetrated, so you have a big upside because the debt to GDP ratios in India is still about 50% compared to 120% in the West. And on top of it, even that credit is not met adequately, which is sort of explained in the 3 billion total AIF market in the country in private credit compared to 200 billion globally. So this single largest segment, so this is probably the fastest growing segment within the providers of capital to this. And we think that's going to continue in this way.
What kind of innovation do you see in this category? So say in Cat 3 you have long shorts, and in long shorts you have different kind of strategies which people have. So here is it more of a single credit kind of strategies, or you have multiple strategies within credit as well? And is there any scope of innovation, or is there any regulatory arbitrage there?
No, so generally private credits, what we have seen is more category 2. The main attempt of private credit funds is to provide the bespoke or the customized solution to the corporates based on their capital structure, the need for capital, either it's for growth or maybe there are some cash flow mismatches, etc. So I think there is by design of a private credit fund, it has to be flexible in terms of in terms of say choice of instrument. You could probably do an holding company transaction, you can do an operating company, you can align your commercials in line with the cash flows of the underlying situation, some towards regular, sometimes more towards back end, So, the nature of the business is such that, there is a flexibility and there is legroom to sort of operate. And that's the main, I would say, objective of why would a corporate really come to from a regular banking or a bond platforms to outside of the credit platforms. So that I think is sort of, so there is a fair bit of legroom and I would say flexibility available to structure some of these transactions out of the private credit funds.
I want to add something to that. There is, so as Rakshat mentioned, there is a lot of innovation that happens when you give money to a company, depending on how you want to customize it based on what their requirements are. So for example, if a company wants simply working capital, then it's a straight vanilla kind of a transaction, right? So for example, if it's a book manufacturer or a textbook manufacturer, then their sales are only in June or July when all the schools start, and the rest of the year they will not have financing. So it's very easy to customize that. But if it is a transaction which involves, say, a takeout, say a pharma company wants to acquire some other pharma company and wants to put their brands as collateral. That is a very different kind of transaction requiring very different kind of customization and tenor, pricing, collateral, everything will change. So suppose you want to put Shell Cal as a brand, and that transaction happened a lot of years ago. But depending on what the need is for that company or for that financing, the innovation comes in to satisfy that need. Now, there is a second layer of innovation that happens at the investor end. Right? When I am investing in a fund, I have a certain requirement in terms of tenor, yield, holding period that I have come in, or that risk level. Right? If I want money in the next 3 months, I will invest in a liquid or an ultra fund. If I want money for my children's education, I might invest in a bespoke 7-year, 10-year kind of product which can give me 15%, or in an equity unlisted kind of product because I know I have holding period. Now, the innovation that happens is also at a desired risk level of an investor. Investors which have a lower risk capital can also come in a fund which has dual senior or junior kind of structures. Right? And this has been in the news recently from a regulatory perspective as well, because you're basically providing a waterfall, saying that if somebody has higher risk, will get higher return, but you can have it essentially in the same structure. The second innovation you can also do is in terms of either a taxation piece. How do you ensure that an investor gets the best possible tax treatment? So we had done a market-linked debenture focus fund at the time when this was not a fashion in 2018, because corporates were taxed at 25-30%, HNIs are taxed at upwards of 40%, which is essentially saying to an investor that if you make money, I will take 40%. If you lose money, I will not participate. So it's a very unequal kind of taxation that happens in retail versus, or HNI versus corporates in India. So tax innovation via MLD can be done at a fund level as well. So the underlying investments are vanilla, but the fund itself has a structure where the risk is different for different kinds of investors, or because of taxation, it is structured that way. Then there can be innovation on a liquidity basis as well, where you can provide certain windows of liquidity. You asked about whether there is secondary market in India. For debt, there is none. Even every government security cannot be sold today. Only parts of the curve are liquid. Right? So 10-year is very liquid, 5-year is liquid. 6.5-year government security bond, if you want to go out and sell 2,000 crores of government bonds, you will not find a buyer immediately. So there is no credit risk, but the fact is there is no participant for that tenor right now. Right? There are very few buyers. And as you go down the curve into AAA, AA, unrated, A-rated, the liquidity kind of disappears because there are not many participants in the market. So if somebody invests in a fund and wants liquidity, you cannot provide it on a daily basis, which is what we saw in mutual funds. But you can innovate and structure the product such that there is an interim liquidity. You are given a 3-year money, but you can provide, say, a yearly liquidity for partially. So all of those structures are also innovations because you can't take away from the basic nature of debt in India. It is illiquid, it is customized, and you have to really put in the effort to understand anything where you want more than 10% kind of returns. So the kind of effort versus reward is also very different. So you can innovate both at structure level as well as at the customized level at which somebody wants the money.
So just adding to your question, so what kind of, given the illiquidity which is there in this segment, so what kind of return expectation should the client have on a ballpark basis? And also, where would you fit this in client portfolio? So will you fit it as part of the debt allocation, or will it be part of the alternates allocation?
So maybe I'll take that. So, just to add to Ravi on the liquidity side. So I guess, the AF units as of now are, unlike the mutual fund units, SEBI has recently proposed to make it dematerialized. So I think that should sort of add to a little bit of more liquidity. I think that AF units as well are providing some secondary liquidity. Second is, I think, in terms of sorry, what was your question, Mike? On the return.
Ballpark expectation on the returns.
So I think on the returns, I think let's look at the other way that, look, the repo today is about, say, 6.25, right? I mean, 10-year yield, give or take, is about maybe 730, 740, 750 horizon. I think anybody who invests, and AAA is about 50, 55, 60 bips widening from 10-year yield. So I think anybody who looks at a private credit, investment, I would presume that should expect at least 3 to 4% pickup of from the underlying AAA curve. So I think that sort of leads to about close to 11-12% thereabouts. I think that should be at least the bare minimum expectation from an investor in the private credit fund.
Also say maybe we see a big range of funds in the country. At the tightest is where investors want to do better than the risk-free rates because one, this is riskier from a credit risk perspective. Second, it's illiquid. You can't get your money back when you want to. And third is there's always going to be a fees and expenses on top to sort of justify whether we should invest in net of fees and expenses, is it worth it? And that sort of maybe is the 10, 11%, but private credit funds go all the way till 20%, and the strategies are very, very different. At a 20% sort of a return threshold, credit is all about risk and return. So if you're expecting more return, by definition, you're taking more risk. So the venture debt funds and the special situation funds, they all sort of feature into that 18, 20% range. They are probably 7-year, 8-year funds where you're taking a little bit more esoteric risk because you want that kind of a payoff. The 10, 11% is where you'll take probably the most semi-liquid, lowest credit risk because that's the lowest return. And then one of the things that we've realized as this market is deepening is there are funds coming up at every single pricing point. 11% return fund, a 13%, a 15, a 17, and a 20. And you decide, your clients decide, where would I rather be for the adjustment of risk versus return. And we've seen this market will only develop. One thing that we still sort of, what we don't have enough of is institutional participation in the market. Right? It's still a very corporate treasury, family office driven market. In the West, the institutions drive this risk reward discussions, which is what is the tenor for which I'm taking this risk and what do I need to get paid. I think that's where we will see a lot of this industry mature towards, which is a demand side expectations on where would I be, and then products and funds being formed to customize to sort of that requirement, which I think will happen as this product matures.
So just to add to that point, so a lot of these family offices and large clients have an option to invest in single securities, single credit directly as well, right? So why should they come to a private fund from fund managers like you who are managing it professionally? What value add are we providing to them? Maybe if you can talk about that.
Yeah, I'll try to attempt that. Look, I think credit is not just origination and underlying investments, underlying business, because these are illiquid instruments. There's a lot of monitoring and post-investment work that is needed. Second, creditors which act as a significant portion of the debt stack always have a better bargaining position versus someone who's a standalone individual bondholder. And third is that a single name credit doesn't diversify you enough. You could make 5 investments. Unlike in equity where one stock could go up 300%, one stock is down 30%, debt is a fixed upside business but unlimited downside business. Best case, you'll make a X percentage return. Worst case, you lose your capital. And all of this makes no sense for a lot of investors to try to do this unless they have the financial resources, the ability to analyze individual companies, monitor it, be sizable where they can make a difference in case certain voting actions happen. And hence, it's better to sort of do it through a fund for these investors, which do not have that sort of a bandwidth to do single name credits, where you could end up underwriting and investing, but everything post that, you might not get even the information that these companies are supposed to submit to a qualified institutional investor. So many, many reasons why single name investment has its own upside where you save fees, that's obviously the upside. But the downside is if things go wrong or if you need to diversify a portfolio, you'll not get that sort of an outcome if you invest in single name in a haphazard manner.
And I think the investing in a fund versus investing in a direct transaction, I think the sheer amount of work that one has to do while underwriting a transaction, and credit really works as an ecosystem. Practically, if let's say there are 2 people and there is an X amount of money available, you can actually trade public equities because that's just so hyper developed. But I think in credit, what happens is, it's again the breadth of activities to originate right risk, look at the sector, As Saurabh explained, I think how you monitor if you were in a default situation or in a stress situation, how would that sort of, how would you sort of negotiate with the underlying issuer? I think these things are very, very critical. And, and hence, anybody who would want to invest directly, apart from the concentration risk that the person takes, but I think it's always a good idea to invest in a fund which manages multiple of those transactions and as an ecosystem and as a team specialized, more oriented towards those kind of investments. So that's always a better proposition in our view.
I just want to add one example to this. I think both Rakshat and Saurabh have explained the reasons fantastically. So during COVID, when everybody was at home, so were we. We started baking. My wife was really good at it. And we didn't have to go to any cake shop or get any bread from anywhere. I sucked at it, but she was really good at it. That is the level of skill that you need to become a baker. So you can do that yourself. First is you need to get all the ingredients, make sure there's no wastage. And you can churn out a product which is probably as good as your neighborhood baker or wherever you buy it from. Post-COVID, everybody stopped that, or we have at least stopped that. I don't think many people are doing it now as well. The question is, one is of skill, which I didn't have, she did. If you have the skill to assess a company, source a company, assess and monitor, please go ahead and do it. Secondly, you need to have the time. If this is your main job and you think that you can bring those economies of scale and do it, that is the second thing that people need. The third is margins. Most professional fund managers charge 1, 2, 3%. Right? There are carry structures which incentivize to make sure that the manager makes money only if you make money. So you have to combine on all of these in terms of saying that, do I want to go ahead, take that risk of origination, sourcing, underwriting, making sure that I get it at the same terms as a professional fund manager, invest my time to be able to do it, and God forsake, if something goes wrong, you want to sit at the NCLT and make sure that you are doing with legal to make sure that you get your money back, is a call that an investor can take. Now, there are treasuries or corporate treasuries which are sizable enough, which may want to do part of this. May they decide that, okay, I want to do till a AA or till an A, but I may not want to do it there. So, the answer is nuanced depending on what is the kind of resources, size and time that you can bring to it, and what you aim to get out of it in terms of your own costing versus what professional fund managers charge. Based on that mix, you can decide whether you want to do it directly or with a fund manager.
That was a very interesting example. So anyways, I think another example could be, so a lot of people ask while we are talking in a forum about debt, but equity also, right? People have similar questions, whether to invest in equity directly or whether to do it through a professionally managed manager like through a PMS or an AIF or a mutual fund. I think obviously the difference being, as I think all of you mentioned, in terms of time, it's not your day job, right? So getting the time to research those companies, all these houses, all these providers have a huge research capability. And compared to equity, debt is even tougher given the illiquidity risk which is there. You can lose your capital as well if you don't research it well. Also in terms of getting the money back in case something goes back. So obviously the professional managers will have the experience to get the money back through IBC, insolvency framework, which is now there. But as an individual, it's really hard. So that brings me to the last question. So given it's a category which is not too old, I mean, AIF regulation itself came in 2012, after which we have seen some funds in the last 5-6 years. So how has the investor experience been so far in this category? And going forward, what to expect? What should investors expect as the category evolves further? So
I think CIL had done a report which we can sort of relate to or sort of quote from, where they had looked at all credit category 2 funds in the last 7-8 years. And very interestingly, almost for every year vintage funds that were launched in 2014 till 2020, on an average, it's between 11 to 13% on a post-fees, post-expenses basis. Now, this was before the venture debt market picked up, where people were talking about credit funds largely in the performing credit space. So we don't have a lot of experience where the funds have distributed that original funds that they had raised. So unable to sort of track that. But 11 to 13% consistently every year post fees and post expenses is what this industry has generated as per the CRISIL report. And I think going forward, as more innovation comes, more risk-reward framework comes in, and people can decide whether they want to be at 11 or at 20, depends on the individual risk that you want to take for this asset class.
This is also a time where there's been crisis after crisis. You should look at demonetization, which was 2016. Then you had the INFS crisis that came in, GST implementation, which messed some MSMEs up, and now you had COVID. All of that period, and still the returns are what Saurabh has just mentioned. So when you put that into perspective, the time ahead, where corporates today are sitting on probably the highest control on costs, have been through the entire grinder in terms of the last 5 years in terms of how to operate with supply chain issues, growth demand follow-up, external macro situation worsening, to a time where everybody from corporate balance sheet to household individual balance sheets are probably in the best place over the last 5 years. Means that over the next 5 years, a little bit of it is almost as good as throwing darts. You will hopefully not go wrong. So, such is the macro situation underlying credit right now.
I guess I think the allocation is also progressively with all these data points is also increasing. As more and more funds are coming, more vintage is there, better yields have been demonstrated by the professional managers. I think you will get increasingly more allocation from across the board between family offices, treasuries, and I think the institutional play that is sort of to a very large extent still there is a big catch up to do. I think will progressively increase in my opinion. So with that, I think you will see that the investor experiences will sort of follow up from there.
So I think we are just near the closing time. So in case if there are any questions from audience, so please.
Yeah, we can hear.
We can hear you.
So my question is to all three of you. All of you are managing private credit fund in the form of AIF. So it's an idea. Just I want your reaction on it. So how do you see if there has been a fair bit of traction in the private credit space in a couple of years, and fair bit of track record also been set. The challenge or the asks what's you add value in terms of the fund structure vis-a-vis the direct structure. Why don't you create an ecosystem which will help to downsell? Like as Saurabh mentioned, there is a spectrum from lower double digit, maybe from 11% to 20%. That's the range of this different type of fund with an objective, with the liquidity or the tenure yield. So if some fund falls or the underlying falls from a, suppose your own rating to a one notch down, so it become a portfolio component for another credit fund, correct? So if you as an industry, all the funds together create an ecosystem so that it gives a buffer to the one fund through a exit and maybe entry to another fund with a higher yield appetite. So I see this is one solutions or maybe edge to direct investor who are exploring they are the better judge of credit rather than bringing them to this ecosystem.
That's a great question. Sorry, you want to go ahead?
Yeah, I'll say it's already happening in some ways, except that the funds don't necessarily do that, but the borrower or the issuer does that. And why we are saying it is because assume we've invested in 11%, 12% paper from fund A. The underlying position deteriorates, but hasn't defaulted yet. And they're looking for longer tenor debt. They're looking for some moratorium in terms of when the repayments start. They're looking for additional amount of debt. By definition, they'll go to a 16% fund, and from there, it's going to become a 20% fund. Once the default happens, it becomes very difficult for a 16% fund to participate in that. A 20% might do it. So that's one, which is it's already happening. But the investor or the issuer is sort of leading that, and the fund is encouraging it to sort of do that. Second question that you mentioned around, what was the second question? You had another question to this.
Why don't you as a fund manager help create an ecosystem?
Yeah, it's also somewhat a conflict of interest because you could have different funds managed by the same fund house, where you could have a 12% fund from a particular house that also has a 16% or a 20% fund. So sometimes it's better not to have one fund selling into the other fund, which if something happens to that instrument, then you always have somebody saying it's almost like a related party transaction, where you've warehoused a certain transaction. Yeah. So other funds, but that's led by the issuer, and you encourage them to go seek alternative, more expensive debt, because it's not 11, 12% risk anymore.
I was reminded of something that happened when I was in mutual funds, close to 10 years ago, where there was an Amtech auto default, and one of the mutual funds had it. They tried to sell in secondary, and a lot of the intermediaries were trying to sell it to other mutual funds. Nobody bought it. Imagine if somebody would have bought it. So the fear is also in terms of, and this is more like a psyche kind of thing, right? Where I can participate in a primary, and I have taken that decision wholeheartedly knowing that I have originated and sourced it. If I do it in a secondary, giving an exit to a competitor and then being saddled with a bad asset, that is a real issue. I know this is a fear across a lot of the mutual funds, which is why secondary bond trading in mutual funds never picked up.
Yep.
Because while you may in full faith know that the credit is fine, Amtech is an extreme example, but I'm talking about even lower rated credits. The fact that you might give an exit to somebody who is a competitor mutual fund worked against a lot of the fund managers in terms of saying that I don't want to participate in secondary. Same bond I will buy in primary, but I will not do secondary. It's fine. So at AAA, everybody will do it.
Refinancing happens when the borrower actually benefits because of a lower rate or higher amount. No borrower will refinance a 12% debt with a 16% debt unless it's forced to, which by definition means you are an adverse selection issue that you're dealing with.
Exactly.
One more point worth highlighting is a lot of institutional investors have restrictions on secondary investments by AIFs. So they also restrict you to address some of these concerns around whose paper you're buying, are you giving exit to one of your bank, NBFC, it could be anything, right? I mean, we had a few examples back when the industry was less developed, where people were moving assets from a bank or NBFC into a credit fund and getting external investors. So how do you sort of stop that behavior? There's only institutional investors saying secondary is not allowed. So that market will not be as pronounced, except when genuinely a 12% paper needs to be repriced to 16, and let's go through a full diligence like a primary issue and get a new investor for that.
I had two questions. So firstly, now with the accredited investor framework, you can take in less than 1 CR. For Ravi and Rakshat, where do you all stand on that as for your organizations?
No, I can speak for my, we have a fund 1 which is as of now kind of fully deployed, and we're planning a fund 2, but I think your question is more around policy. So of course SEBI has has pronounced it very clearly that if you're an accredited investor, that your ticket size can obviously be lesser. So I think as and when we are planning something like that, a subset of in our fund 2, and I think we'll definitely be open for that in our setup. Yeah. But that definitely has helped because, it's a more specialized investor. There are certain criteria laid out. And if you sort of comply with that, you can invest in that category with a lesser amount and lesser ticket size.
The thought process is right. I mean, earlier, SEBI put the 1 crore ticket size as a corollary for identifying an investor which knows the kind of risk that they're taking, which if you ask somebody to go through and prove that ability via accreditation, then it makes sense. So far, it's not taken off because you can probably count the number of accredited investors in the country on your fingers pretty much. It's less than 100 right now. And this is something that the regulator is looking at. It is going to be a bigger thing from now on. The process will be easier so that access to a lot of the higher yielding assets, whether in debt or equity, is made available to anybody who understands the risk they're taking. As long as you can address the mis-selling aspect of it, which is what accreditation does, it's a great concept.
Just one more question. If Ravi and Rakshat can comment on your experience with kind of NCLT or borderline NCLT cases. I know the track record that's displayed is very, very good, very impressive. But behind the scenes, what have you seen? What challenges have you faced? Thank you.
So, thankfully haven't come across NCLT door in Fund 1, so I know that's a good thing. But I think, any investment that sort of goes and deteriorates significantly, first of all, I think there is a significant teeth now available to lenders, which is the AF as well, that you would sort of do that. And there are various ways and means to sort of resolve it. But I think, from a legal enforcement perspective, I think IBC mechanism is good. There is definitely a fear psychosis. I mean, this is definitely much better than what we have seen in 5-7 years back. IBC came in 2016. So I think there is at least I have been doing this, for all my career. So, I think how entrepreneurs, promoters are approaching borrowing today vis-a-vis what they used to do it earlier. I think there is definitely a sense of a better discipline. There is a sense of, an approach that they are taking, that they need to be more trimmer, and then there is more teeth available to the lenders to sort of file an NCLT application. And nobody would want to sort of derail the company, but just sort of getting into NCLT. Second point is, I think within NCLT frameworks also, I think it's a little bit mixed bag, where I think some corporates have sort of seen resolutions very fast. Some resolutions have sort of dragged it over a period of time. So I think, but all in all, I think it's a very, I look at it as very lender friendly.
Do you see going forward that the private credit market coming forward and helping professionals and smaller entrepreneurs to acquire a larger company under NCLT and to make it grow?
I guess that's a little credit assessment question. I think if your question is that, let's say, would you finance a borrower to acquire an NCLT asset? So, that really then depends upon the borrower pedigree, the borrower's track record, performance, and what sector it is in, and there are a host of things. But I think if the underlying borrower or that entrepreneur's, eligibility or overall track record and things are in order, then of course it is by all means that you would sort of finance him to buy a stressed asset. And there have been a lot of cases over the last 5-7 years where the NCLT assets are getting bought by other business houses and other entrepreneurs. So that has been common. But I think what you see is much more larger assets. But I think you can see Reliance Capital is getting negotiated every second day. So I think that's there. So that's already there. So that's a good thing.
I think if your question was, I don't put any equity, will somebody finance me 100% to take over this asset as a professional? Or?
That is never. Okay. It's like, pure professional player are coming up, or maybe a smaller business house, good track record of a particular industry, and a larger asset is...
yeah, so I think track and alignment of interest, which is how much equity are you putting in ahead of my debt, because that's how that's why I'm a lender and not the owner of the asset. But as long as those two criteria is met, which is track record and some sort of alignment of interest, I think it's a
I understand that. Appreciate. I know further that I want to ask one more question. Many times it happened that the traditional lender, who were the lender to a particular business, were not willing to lend further for the growth, though it has been acquired. If larger guy is acquiring, he has enough collateral, bandwidth, banking limit, reputations. When a professional guy is acquiring, maybe a smaller business with a good track record is acquiring a larger business. So getting a funding inside the business itself is a challenge. So there are two ways of opportunity for private credit. First, I got the answer of funding to the acquirer. Another is, funding the business for a transit period of say 1 year or 2 years, when existing lenders are not willing to fund further.
As you said, there's a fund for every yield and every kind of risk. So
yeah, I'm sure somebody will, if the risk reward is right, whether one of our funds does or somebody else, but we think this sort of a risk is already being funded and will continue to get funded at the right risk reward.
Yeah, just to add, there are stressed asset funds which are there, which actually invest in some of these companies which have become NPAs or which have gone into NCLT. They buy with other companies as well, other institutional investors. So those kind of funds are a separate, I think, non-performing credit or basically distressed assets. So that's something which is a big category overseas. In India also it is picking up. In fact, there are a lot of global investors who are investing in India.
Thank you.
Thank you so much, gentlemen, for the answers. And now it's time for the wrap up. Thank you so much again for this powerhouse session, I must say, wherein it was a wonderful Q&A session as well. For the felicitation, may I please call on stage Ajay Vaswani from ITI, President and Chief Business Officer for Alternative Investments. Everybody, big one. Oh, from that. Why there is so much of silence? I want claps, please. Lovely. Thank you. Thank you, gentlemen, so much. Now, a picture together, please. Well, that was great. Thank you so much, everyone, for giving us time at that stage.